going to start with talking about homework. All right, so first question. Why was PepsiCo's diluted earnings per share lower than Basic's earnings per share every year? All right, so this is basically just asking us why is Basic earnings per share lower than diluted earnings per share? What do y'all think? Yeah, right. Basically, there's just more shares when we estimate the number of shares in the diluted format. Right. So basically, the difference that we're looking at here is the basic is just how many shares the company has outstanding right now. Right. That's the easy way to look at it. But usually, there's going to be this diluted amount, which is just a little bit more shares outstanding that's stemming from outstanding contracts that are likely going to be converted into shares in the upcoming time period. Right. So very often, executive compensation will be tied. Will include some sort of share performance, right? Often stock option benefits for employees, stuff like that, right? So this diluted measure of shares outstanding, there are slightly more shares outstanding, all that stemming from the assumption that these contracts that we have outstanding are likely going to be converted to shares in the near future. All right, so generally speaking, we'll always see that diluted is less than basic earnings per share. All right, how much did PepsiCo's revenue grow by? All right, like I mentioned in that email, not a great way to approach this, like revenue grew. Yeah, right, we can see that. We want to explicitly measure how much this growth is going by. All right, so we're going to focus on 2018, 2019. We'll just go ahead and hide that. All right, so we'll start with the dollar change. It's a 2,500 difference, $2.5 billion difference in revenue when we scale it. All right, so looking at the dollar change is one way we can look at this growth. What is one issue with looking at the nominal dollar change? That's true. We don't know what affected it, right? But more what I'm trying to get at is why would we also look at percent change? What's the benefit looking in relative terms? Exactly, comparability, right? If we just look at the nominal dollar change, it's not giving us any sense of scale, right? So if we compare PepsiCo to, all the startup brands are basically owned by Pepsi and Coke that I know of. Liquid Death, right? New water company. Don't think they're owned by any of these yet. If we compare this net revenue change to a company like Liquid Death that's a much smaller startup, this is going to be drastically larger and it's incomparable. So what we really have to look at is what is the percent change to give us the relative basis for a comparison. All right, so we're going to look at the percent change in revenue as well. All right, and the percent change is what it grew by minus what it started from divided by what it started from. All right, 3.87% growth in the company's revenue. Now we have a comparative basis, and we can compare PepsiCo to its previous years in growth and also to its competitors, right? We want to start with looking at nominal differences, but that's not where we end, right? We have to take the next step and look at the percentage growth so we have our relative basis to gauge this. All right. Any questions on calculating this change in revenue? Okay. All right. So revenues were higher, but earnings per share was lower. What did you guys identify as the main cause of this? Okay. What, say that again? Okay, which two expenses? Yes. Yeah, that's the main one that I was looking for. The by far largest difference between the 2 years is how much income tax the company paid. Right? It looks like in 2018 they had a refund, and in 2019 they are paying taxes as should typically be expected. Right? So while they grew revenues in 2019, their net income still ended up being significantly lower, and almost the entirety of that change in net income is the difference resulting from the taxes that this company paid over these two time periods. Right? And there are many ways that we could come about this, right? If you wanted to be explicit, you could do a cause of change analysis and pinpoint what exactly resulted in these differences. You can also look line by line, see where the biggest differences come up. As you become used to looking at financial statements, you can just skim through the line by line items and look at where the largest differences are, right? The second highest difference would come from other pensions, as you pointed out. But as you're going down and looking at the differences, by far the largest difference between 2018 and 2019 expenses are coming from provision for taxes. How much taxes the company paid. All right. So taxes were the largest difference, resulting in this difference in earnings per share, despite there being higher revenues. All right. Now, did PepsiCo use its assets more or less more efficiently in 2018, 2019? All right. So let's go to asset efficiency. What's the measure of asset efficiency that we should use to compare these 2 years? This was something that we went over, I think, in our second class. And how do we calculate that? Exactly. All right, so we take our revenue and divide it by total assets in that year. So we're going to have to go over to our balance sheet, look for total assets, copy that over. So now we're looking at how much revenue are we generating. Actually, I should have that in dollar sign. How much revenue are we generating for each dollar in assets? All right, but this is completely a comparative basis, changes over time. Right, so this is something that we need on a comparative basis, right? Depending on industry that companies are operating in, is going to determine how much assets they need in place in order to generate their revenues. Right, tech companies tend to need less assets to produce a given dollar of revenue. Any sort of manufacturing company is going to require more assets. Right, that's the general range of asset efficiency. But now that we scale it, we see that for each dollar in assets, the company, PepsiCo in 2018 generated 83 cents in revenues. 2019, it generated 86 cents in revenue for each dollar in assets. All right, so we know that assets went up. Let's double check what happened with, or we know that revenue went up. Check what happened with assets. Assets increased as well, but the amount of revenue being generated per dollar in assets increased over this time period. All right, so overall, which time period is PepsiCo generating assets more efficiently? 2019. Yeah. All right, so despite it having lower earnings per share, it's generating its assets more efficiently. All right, and lastly, do we think that Pepsi had liquidity issues in 2018 or 2019? What methods should we use to answer that question? What formulas? Short and quick. I guess technically we should switch over to the balance sheet for this, but in order to keep it on the same page, we'll just stay here. All right, so I always forget these. Current is cash and equivalents and short-term investments. I always forget this ratio. Thank you. Liabilities. So in 2018, it looked like there was a 1-for-1 dollar in current assets for each current liabilities. Not quite, right? Slightly under 100% coverage. But in 2019, companies' current assets decreased relative to their current liabilities, so they have less ability to cover. Yeah. We can also look at the quick ratio. Can you remind me what that one is? And we see an even larger drop when we transition. All right, so 2018, maybe not so much of a liquidity issue. 2019, a little bit less liquid. But like we're going to be talking about later today, these are just one of the metrics for looking at liquidity. And they're not necessarily as informative as when we translate the company's cash flows and use that as our ratio to gauge a company's liquidity. All right? When we're looking at companies from a cash flow perspective, we understand that decreasing our current assets and increasing our current liabilities is an improvement in cash flow for the firm. All right, so these measures of liquidity, while they do reflect the company's ability to match assets and liability cash flows, are not necessarily reflective of the total value being generated. There's one additional measure of liquidity that's a little bit better for gauging a company's ability to pay off its expenses, and that's going to be in our income statement. What measure is that? How much can the company cover its interest? All right, so we're just going to multiply this by -1. We get the positive value, so we'll get our interest expense divided by our revenue. And here we see the exact opposite thing going on, right? The company's interest expense proportional to the company's revenue has improved, right? So does the company have liquidity problems? It depends on how you look at it, right? Based on liquidity ratios, it looks like their liquidity issues have deteriorated slightly over this time period. If we focus more on the actual interest expense that the company is incurring, their standing has actually improved a bit, right? The proportion of revenue going toward interest has declined. My personal opinion, I think it's that latter measure that is a little bit more informative of a company's ability to cover its interest, but it's debatable, right? You can make an argument for either. You're not necessarily wrong so long as you provide some justification for why you think that's the better measure. All right, so did the company have liquidity issues? It depends. Any questions on the homework? All right. All right, so today we're going to talk about the cash flow statement and free cash flow. I'm going to try to wrap up the class talking a little bit more about free cash flow and putting it together. All right, so the three financial statements that are relevant to companies: income statement gives a reflection of the revenues, expenses, and net income being generated in a given time period. The balance sheet reflects sources and uses of cash and the accumulated profitability of a company over time. Right? If companies are consistently profitable, we should see growing balance sheets just as a mechanical reflection of growing retained earnings over time. Hopefully those companies are reinvesting those additional earnings into productive assets. And lastly, we have the cash flow statement. And the job of the cash flow statement is basically to adjust those other two balance sheets to reflect how much change in cash occurred over a given time period. All right, and so the cash flow statement is broken into these three general categories: cash flow from operations, so the productivity of a company over time. Depending on the method for putting together the cash flow statement, is going to then bring us to what information is directly reported. But generally, we're going to use the indirect method. So we're going to start with net income, the bottom line of the income statement. We're going to add back any non-cash expenses, deduct actual cash operating expenses like change in net working capital. That's going to bring us to our operating cash flows. Then we have our investment cash flows. These are cash flows that are made from buying or selling long-term assets that companies invest in, right? In other words, the investments that companies have to make in order to generate their operating cash flows. And lastly, our financing cash flows. So money being raised through issuing securities, money being paid off, paying off securities. Money that is used to help fund investment activities, which is then used for operating activities. All right, so everything a company does is interrelated, and the flow on the cash flow statement is basically bottom up. So sometimes companies need financing, right? Especially early on in their life. They use that financing to invest in investment activities. What's going to be used to generate their operating performance? So our overall change in cash, we start from our top line, change in operating activities, cash flow from operations, net out our cash flow from investments, net out our cash flow from financing. And there are different ways to report this. Typically, we're going to see investment and financing are going to be subtracted out because over time, that's typically just how things go off for a company's performance. Or I'm sorry, investment is usually netted out. But we'll see how this bears out in actual companies' financials. All right, so why are we bothering with this adjustment? There are a lot of reasons, right? We've gone over a couple of them. One of the most important, though, when we're looking at the cash flow statement is asking, is the company generating enough cash from its operations to sustain itself? And over the course of a company's life cycle, the answer to this may be different. And depending on that answer, it could imply that the company is having some issues or not. Right, so early on in a company's life, it's not uncommon for them to not be generating enough operating cash flow to sustain itself. Right, that's why we'll often see that companies are going through and issuing external capital in order to fund its investment activities, its operations. But as companies grow, they should be able to have sufficient operating cash flow to fund themselves and being able to not rely on external capital markets to make their investments and operations run. Right, companies should be self-sufficient over time. Can companies pay off existing debts? Right, so this is what we're going to talk about toward the end of class. Companies need enough cash generated internally to sustain themselves. Right, they need to be able to pay off their interest expenses. If they're not generating enough cash to do so, the company is in trouble. Right, when companies start issuing debt just to pay off debt that's already outstanding, that starts to lead to financial deterioration in companies' inability to continue existing. Is the company going to need external financing? Right, if they have very strong investment needs and they don't have sufficient cash to pay for those investment needs, then yeah, companies are going to have to raise external financing. They're going to have to raise capital. If the company has unexpected obligations, are they likely to be able to pay those obligations? Right? How likely are those obligations to occur over time? And lastly, if any investment opportunities come up, can companies take advantage of that? Right? So these are, broadly speaking, what we're trying to answer when we're looking at the cash flow statement, because they're not necessarily available in the income statement. Right? Remember, this is coming down from the difference between cash and accrual accounting. Cash reflects money changing hands in it being immediately available to you. Accrual does not. It's recognized when an economic event occurs. It doesn't necessarily mean you've got cash in hand. And the timing of cash matters for the value of it. All right, so there's two general ways that we can show our operating cash flow. There's the direct method. So we start with cash receipts. These are all in cash terms. Cash receipts from revenue, net cost of goods sold, so cost of generating the revenue, net selling general administrative, cost that the company incurs that's not net directly tied to every dollar of revenue, minus interest expense, minus taxes. Very often, though, we're going to see the indirect method. Right? The indirect method basically just starts from the bottom line of the income statement and then makes cash adjustments to the net income. All right, so depreciation and amortization is not a cash expense, it's added back. Capital expenditures is a cash expense. It's cash out of pocket that the company pays, it's netted out. Change in net working capital is also cash expense that the company incurs. All right, so very often we're going to see the indirect method because it's reflected of material that's already in financial statements, so it's more readily available. All right, so the general flow of the cash flow statement, we start with operating cash flow at the top. We have our investment cash flow, typically netted out. Our financing cash flow, so money raised through issuing securities, paid off through paying down securities. That's going to result in the change in cash balance over a given time period. We add in our beginning cash balance, so how much we start off with, that gives us our ending cash balance. All right, so an example looking at the direct method. All right, so this is CVS. Remember, this is all in cash. So this is revenue recognized when cash actually changes hands. All right, so cash revenue received from customers. We have our cost of goods sold netted out. We have our selling general administrative, net interest received and paid, and finally taxes paid out. It looks like over this time there is a general decline in net cash from operating activities. If there is any segment that you want to see growing bottom line performance, it's generally in the operating activities of a firm. If we see trends of declining operating activities over time, that's reflective of poor operating performance by the company, and they have to make significant changes in order to change that. The indirect method, and likely what you're going to see more often, we start with the bottom line. We make our non-cash adjustments. Right? Depreciation and amortization is a pure accounting expense. It's not cash out of pocket from the firm. We add it back. We have short-term working capital in the next few sections. Actually, most of the next sections. And where do we have it? Accounts payable. Net cash from. Okay, yeah, so this is all just going to be a mix now of change in net working capital. And that again brings us to our bottom line for operating performance. Investing and financing will be reported more similarly, right? So there's not as much discretion that companies have over how they report this information. Right, so investing activities largely going to be changes in property, plant, and equipment, so capital expenditures that the company is performing. Right, typically we're going to see cash outflows as companies are investing, cash inflows as companies are shedding investments. Right, proceeds from disposal. As companies switch from investing to divesting, we'll see a change from cash payouts for the property, plant, and equipment to the disposal of receiving money for those assets. Right, so as companies are investing and growing and working on increasing the revenues, we should see that investing activities is increasing over time. If companies are more in the divesting pattern, so generating more revenues from fewer resources, trying to generate them more efficiently, we'll see declining investing activities. Right, so it's not necessarily an objective positive or negative. Right, whereas operating cash flow, we want to see continually increasing operating cash flows. It depends on the company's situation and what their investing activities look like. All right, so as we see a decline in investing activities, that's not necessarily reflective of value being added or destroyed. It just depends what's going on with the company. Right, in this case, the company is investing less in property and equipment and receiving more money from selling off existing property, plant, and equipment. And lastly, we have financing. All right, so the company structure is going to reflect the largest changes that we're going to be seeing here, right? So whereas with investing activities, most of it is going to be in changes in property, plant, and equipment, we can't say the same for financing, right? Depending on the company structure, we'll see differences in what the largest components are for the company's external capital structure. although generally the short-term portion is going to be typically smaller than the long-term. All right, so we have proceeds from issuing debt, payments from issuing debt, paying off debt ahead of time, net of dividends being paid, and purchasing stock. All right, so all different financing activities. So if companies are going to be raising debt, we're going to see that come up in the company's cash flow statement, cash available for the company to use. If the company is paying off its debt regularly, we should see that those debt repayments are showing up here. If the company is paying off debt early, we should see that come up here as well. Right, so any effect on the company's cash position is reflected in the cash flow statement. This includes the company paying out dividends over time. Right? Company's net income can be split into dividends paid out to shareholders and money retained within the firm. So if dividends are being paid out, that's money that is not going back into the firm, and it's a cash payout from the firm. So it's reducing the amount of cash that the company has available to it. Similar with purchasing company stock, if companies are engaging in repurchases, there's less cash available to the firm overall, and it's a use of cash. Any questions on cash flow statements? All right. Bottom line here is similar to the investing section of the cash flow statement. There's not necessarily a single trend that you want to look for, right? Again, operating cash flows, generally you want to see that improving over time, right? There's no ifs, ands, or about that. You want to see improving operating cash flows. If companies' operating cash flows are deteriorating, that reflects poor operating performance, and you should hope or expect changes are going to occur. Investing activities depend on the company's life cycle. As they're growing and trying to improve their revenue, they're going to have to increase their investments over time. We should expect investing cash flows to be taking out. Financing activities, it kind of depends how that is being tied to the company's investments. All right, so again, we have more layers of if-thens, conditional opinions going on here. So if companies' financing activities are directly tied to investing in cash-generating assets, that's great. Right? Like we saw when we were looking at Pepsi, the company's revenue per assets were increasing. So if you're investing in more assets and generating more revenue efficiently with those assets, great. Continuing investing in them. But if companies are issuing significant amounts of external capital, which looks like it did in the third time period here, then we should hope that they are putting that capital in productive assets. Right, so you have to go back up over this time period. Was there a significant increase in property, plant, and equipment, or were they using these debt payments for something less productive, like increasing dividends, or are they using debt to pay off previously issued debt? All right, and this brings us to free cash flow, one of the most important measures in our field. Right, free cash flow is what we're going to be using to measure value being generated or destroyed. All right, so broadly speaking, free cash flow is cash available for discretionary purposes. All right, it's cash that's generated and available to the stakeholders, primarily debt and equity holders in the firm. All right, and this is going to be our measure for value created or destroyed over a given time period. And as we're going to see, there are a few measures of free cash flow that we can use. All right, this is a non-GAAP measure, so there's not explicit control over how it's going to be measured. And as we'll see, there's some discretion over how exactly we calculate free cash flow. All right, the first method, it's the lazy method. And companies do use this. Actually, I'll pull up a footnote to show this. All right, all they're doing is taking operating cash flow of a firm that they're getting directly out of the cash flow statement minus capital expenditures. All right, so I call this lazy method, as you'll see when we look at the other two metrics. It excludes a lot of relevant information, but because this is a non-GAAP measure, companies have discretion and say in doing so. All right, so we'll pull up MK, get the free cash flow. All right, so Right? They give you the note, this is a non-GAAP measure, so they're just giving you additional information that they think is important. How do they measure it? We define free cash flow as operating activities minus property, plant, and equipment paid over that time period. CapEx. This is the lazy method for calculating free cash flow. Unless you are forced to do this, it's better not to opt for it because it's excluding a lot of relevant information. Okay. We have the bottom-up approach, which is the approach that most companies and people take largely because it's easier to calculate. So again, we're taking all readily available information from the income statement and balance sheet and combining it to reflect the free cash flow generated over a given time period. We're starting with the net income from the company, adding back depreciation and amortization because it's a non-cash expense, netting out capital expenditures, netting out change in net working capital. And this is giving us the cash flow generated from the company's operations that they can use for discretionary purposes. And lastly, we have the depreciation tax shield method. Nope, I forgot to include depreciation. I'm missing that key item. There we go. Depreciation tax shield approach, now with the depreciation tax shield. All right, to measure this, we take our operating income, net of our tax, and this is the important bit of information. We add in how much taxes we save from the depreciation expense. All right, and then net out CapEx, change net working capital. All right, so you're going to arrive at different measures of free cash flow depending on what measure of cash flow you use. So there's discretion over using this because it's a non-GAAP measure. Companies aren't required to report it, but it's almost unanimously reported across all companies because this is how companies are valued. When an investment bank goes to value a company, free cash flow is how they measure it. The standard measurement of companies' value is with free cash flow. So it's absolutely vital to understand this and apply it because this information is what is used to value firms. It's the starting point from any valuation metric. Right? And there are cash flow methods that aren't included here, but are usually some take between the bottom-up approach and the depreciation tax shield approach. Right? And again, you're going to arrive at different cash flows depending on what method you choose. So there's not one single correct answer. It just depends what you think is the best metric to use to gauge companies' cash flow. All right? So again, this depreciation tax shield approach is in a way the most informative. It's explicitly including the information that we need to get cash flow, and it's reflecting the actual change in cash from having the depreciation expense. Right? Depreciation itself is not a true cash outflow, but it is saving the company some income taxes because it's reducing the taxable income. Everything else equal, the lower your taxable income, the lower your taxes are going to be. So if you have a high depreciation expense, it's reducing your taxable income and therefore saving you some taxes. And that's what the depreciation tax shield method reflects for us. Any questions on calculating free cash flow? All right. So again, many measures of free cash flow. It's a non-GAAP expense, so companies have discretion. Usually one of these two are going to be the better measures. Bottom-up approach will be more frequently used because it's easier to access. The depreciation tax shield approach is in a way more informative because it's including the depreciation tax shield, which is a true cash savings on the company's part. All right, so again, why bother adjusting net income? I know we've talked about this, but it's important to repeat it because it's one of the financial truths that we deal with. Net income has pure accounting expenses, right? The income statement is based on accrual accounting, and we know that there are some expenses reflected there that aren't true cash changes to the firm. Depreciation and amortization is not a cash outflow from a company. You're not paying cash out of pocket for that depreciation expense. On the flip side, you are paying cash out of pocket for capital expenditures and changes in net working capital. So we have to make these adjustments to reflect true changes in cash on the company's income statement. Change in cash position that really reflects value being generated or destroyed. Big part of the reason why the cash flow statement became mandatory. And the timing of cash exchange matters. Cash today is worth more than cash received in the future. So when we reflect true changes in cash, we're giving this time value of money adjustment that's necessary to understand, right? We need the true timing of cash flows occurring in our valuations because the differences of just a year can result in differences in value of a cash flow stream. Right? And the general takeaway we want to know from this is cash received earlier, cash inflows received earlier than cash outflows is better than the converse. Right? Tying ourselves to cash expenses right now that are tied to future cash inflows is a basic setup for financial insolvency. Oh, a couple more to look at. So like I mentioned, free cash flow is a non-GAAP measure. Companies have discretion over the formulas that they use. Analysts have the ability to choose their own formula. You can adjust a company's financial statements to see what you think, or to apply what you think is the most relevant free cash flow formula to use. Right? So you have that discretion as an analyst. It goes a step further, unfortunately, even within a given formula. So if you choose the depreciation tax shield method, there's discretion over how you calculate the measures. Right? One of the best examples of that is change in net working capital. Right? What capital components are actually relevant to a company's operations? And there's active argument over what the best way to measure change in net working capital is. Right? Is cash holdings, changing cash holdings, reflective of cash tied up in operating performance? Typically not. Right? So very often people will exclude changes in cash from change in net working capital because cash balances aren't directly tied to the operating performance of the company. Are accounts receivable, accounts payable directly tied to operations? Generally, yes. Right? Generally, companies are going to have some sales made on credit, some purchases made on credit, so those are directly tied to operating performance of the company. Is inventory necessary? Generally, yes, but some people will argue that it's not. Right? So there's discretion over what formula we use for free cash flow. There's discretion over what inputs are actually relevant within each formula. So there's actually a lot of gray space within free cash flow for what the appropriate measure is. Kind of up to you as an analyst or as an investor or whatever your role is to determine what you think the best metric is, what you think is most appropriate for the company you're dealing with. Right? Like a lot of the things in this field, right, there's relativity in how we examine it. Free cash flow is one of the best examples of it. We know free cash flow is, generally speaking, the best metric of value because we need those cash adjustments to net income. We need to know the timing of when cash actually exchanges hands because of time value of money. But within that knowledge, there's a lot of leeway between what is the most appropriate formula. And I will say the lazy approach, I dubbed it such because it excludes a lot of relevant information. Probably not a good one to use. But from there, you can make arguments for and against the different measures of free cash flow. Right? There is benefit for using the depreciation tax shield method, but a lot of the measures that we need to put into that are a little bit more difficult. Right? Estimating the company's tax rate on a regular basis can be difficult, especially when we make adjustments for non-cash expenses. So people have the ability to pick and choose what they think is most relevant, do a good job figuring out what is the relevant measure of cash flow. Then once you pick that measure, what are the inputs to that measure of cash flow? All right, so before we go on, we're going to work now on putting together some of these free cash flows. All right, we'll start with the lazy method. All right, so all we need to get the free cash flow under this method is the operating cash flow. So we'll go to our cash flow statement. They're using the indirect method. Net cash from operating activities. We'll just get this for 2023. We'll get our Property, plant, and equipment. Actually, we'll sum that all up. And we'll get our free cash flow. So we get our operating cash flow net of our capital expenditures. All right. So we have our first metric of free cash flow. Next, we'll get the bottom-up method. So for this, we're going to need our net income, our depreciation, our CapEx, and change net working capital. All right, so CapEx we already have calculated. The rest we're going to have to get back. All right, so we can take this directly from the income statement, or we can just go to the cash flow statement. It's where this company is starting, right? So we start off with our net income. So we start off with net income. Get this in cash. We'll get our depreciation. See if we have that. Yep. Depreciation reported. Changes in net working capital. All right, so we're going to have to go ahead and calculate this. So oops. All right, so we have our receivables and inventory. Minus our payable, liabilities, and income taxes. All right, so this is one portion of our change in net working capital. Just as a reminder of what formula we're following along here. All right, we have our current assets minus our current liabilities on a given time period. That's what we're starting off with. We take our current assets, the sum of those, minus the sum of our current liabilities. We'll probably have to get out that sum. Yeah. Minus our current assets and current liabilities from the previous time period. All right, so we have the first section taken care of. Now we're going to get the current assets and current liabilities of the previous time period. So we'll go back to our cash flow statement. We'll get our receivables plus inventories and that's everything. Put additional brackets around to make sure that these are making sense. Okay. And minus our liabilities. So we can sum these up at this point. Liabilities and taxes payable. There we go. All right, so we have our change in net working capital. And now we'll get it all together. So we have our net income plus our depreciation, net our capital expenditures, net our change in net working capital. All right, so total free cash flow, $21,000. All right. Now things are going to get a little bit more complicated because there's more information that we have to include. All right. So we're going to get our net of tax revenue, cost of goods sold, selling, general, administrative. So we might be able to look at that in cash flow statements. We're going to need our tax rate. We're going to have to calculate the tax rate for the company. Then CapEx, change net working capital, those are going to be the same that we just calculated from the bottom-up approach. All right, so let's put together the information that we have and then go to calculate what we don't. So we need our revenue, net of tax. Cost of goods sold, net of tax. Selling, general, and administrative, net of tax. All right, so we don't have that information. We need our depreciation tax shield, then CapEx and change net working capital to get our free cash flow. All right, so CapEx, we have. Change net working capital, we have. So we're going to have to get information together for our net of tax revenue, cost of goods, selling, general, and administrative, and our depreciation tax shields. All right, so at the bottom here, let's go ahead and get our tax rate. So tax rate, we can go over to our income statement, provision for income taxes divided by taxable income. Tax rate that year of 33.64%. All right, so to get our revenues net of tax, we're going to take our total net revenues, right? They have net sales and membership income, so we're going to use our total revenues. Reference the wrong. And it's supposed to be 1 minus the tax rate. All right, so we'll go ahead and fix reference here. And we'll start updating this information. All right, so we are changing our cost of goods sold to cost of sales. All right, so now we have our cost of sales net of tax. Now we need to update our selling, general, and administrative, operating costs, net of tax. Now we're going to get our depreciation tax shield. All right, so for our depreciation tax shield, we're likely going to have to get that from our cash flow statement, depreciation and amortization, and multiply that by our tax rate. All right, so let's see what our free cash flow is with this next method. So we have our revenue net of tax, net our cost of goods sold net of tax, net our selling, general, and administrative net of tax. All right, so we've got this first portion taken care of. Now we're going to add in our depreciation tax shield. Net out our change in net working capital, or our CapEx, and our change in net working capital. Oh, did I add in free cash flow? Yeah, I double subtracted CapEx. Let me just double check that. Capital expenditures. Yeah, so that should be added back since this is a cash outflow. There we go. Yeah, so I'm adding in the CapEx because it's reported as an expense in the cash flow statement. So I made that mistake when looking at the free cash flow. All right, and this brings us to the free cash flow for the company. All right, so this company, Walmart, had a positive net income of 11 billion. But when we look at the different cash flow measures, we're starting to get some different perspectives, right? Using the lazy method that they reported using in their 10K, we get a positive free cash flow pretty similar to the company's net income. But when we start adding in more information, what happens to the company's cash? Right? Looking at the company's free cash flow, we start seeing that it's declining once we add in relevant information. Let me double check the change in net working capital now that I'm thinking about it. Okay, yeah, we did see a big change in the net working capital. We went from, we had a total cash increase over this time period. Total cash tied increase in current assets, and current liabilities looks like they largely decreased over this time period as well, right? So mostly what we're seeing here with this negative cash flow looks like it's stemming largely from a big change in the net working capital. Cash flow statement, capital expenditures increased a decent amount as well. Right, so that's part of the reason why we're getting this negative free cash flow over this time. But it's also part of the reason why we should always translate our net incomes into free cash flow, because we can arrive at significantly different results when we're translating accrual profits to cash profits. So it's very important to make these adjustments because there can be drastic differences. And sometimes the more changes that we make to a company's bottom line to reflect true changes in cash can lead to drastic differences in estimating whether value was created or destroyed. Any questions on calculating free cash flow? All right, again, there are many different metrics of free cash flow. There's not a single right answer. I would argue that that first method that we started off with is probably the worst one to use. But from there, right, we're just basically adding in more layers of information. And as we saw in this last method of calculating free cash flow, it takes a little bit more work to get to this bottom line. Right, so very often, people will go with kind of the in-between method with the bottom-up approach. It incorporates most of the relevant information, most of the relevant changes. Biggest issue it doesn't account for are the tax savings from having a depreciation tax shield. But other than that, it is much more informative still than the net income that we look at. Right? And again, you can arrive at drastically different answers when you're adjusting for these non-cash changes relative to the net income of the company. And so this brings us to looking and considering some performance metric ratios, or just some general ratios relative to the typical ones that are related to income statements and balance sheets. Right? It's very important to understand that companies' operating performances are one of the most important metrics in gauging that company's performance. Right? This is one of the top line issues that are relevant for a company's performance over time, because it's a straight answer across the board. Is the company generating enough cash to cover its operations? If not, what are they doing to change that? Right? Over time, we should see companies' operating cash flows increasing, but how are those increases relative to some of the other metrics? Right? So you have asset use efficiency related to revenue. There's also asset use efficiency for generating operating cash flow. And arguably, I would think that this is a better metric gauging a company's performance, because the more dollars you're getting out from an operating cash flow perspective for each dollar invested in assets is producing that revenue more efficiently. Right? We know that revenue is our top line issue and we should generate that as efficiently as possible, but cost management is also related to that. Right? If companies are not managing their costs well at all, then we can still see the company's operating cash flow deteriorating relative to increasing revenues. Right, so what is the company's operating cash flow relative to its revenue? You can also translate this to operating cash flow relative to assets. Are our assets generating our operating cash flows more efficiently over time? What about our return on equity? If we were to raise additional equity, would it be worth that capital expansion? We can also compare our operating cash flow to our net income. Right? The bottom line performance of the company's income statement, how does that translate to the true operating cash performance of the company over time? And lastly, our cash flow per share. Right? We look at earnings per share, but as we know, net income is not the best metric of value. Right? There are ways to still manage companies' income statements that result in net incomes that are higher than should be expected. Once we adjust for changes in cash, most, if not all of those ways to manage a company's income statement disappear. right? Because it's those non-cash changes that companies have some discretion over that can result in higher net income. So by making those cash adjustments, we take out all of that discretion that companies have over their financial statement management to reflect true changes in cash over a given time period. So by looking at the operating cash flow per share or free cash flow per share, we're getting a much better metric now of the company's performance for a given share outstanding. And like I mentioned at the start of class, there's also metrics that we can look at to determine whether the company has sufficient cash flows to pay off its debt expenses, right? So debt coverage. What's the company's operating cash flow relative to its total debt? Interest coverage. How much of the company's interest can they afford to pay off given their operating performance? How much of the company's reinvestment is capable of being paid off through the company's operating performance, right? Every metric that we've looked at with any sort of profitability so far can be translated to the company's cash flows. Whether operating cash flow or free cash flow, you can translate it and replace some of that information with the company's cash flow performance in order to truly gauge the company's ability to pay off debts and reinvest. Right? Going on down to debt repayment, can the company pay off its debt expenses? And how is the company's dividend coverage looking? Right, so that question in the homework was somewhat loaded in that, is the company facing financial deterioration? It depends how you measure it. It depends how you look at it. And arguably one of the best ways to gauge that is, what is the company's operating performance relative to its financial obligation? And is the company able to cover those financial obligations purely through their operating performance? If companies are run well, yes, right, that should consistently be the answer. If a company is run well, its operating performance should be able to cover its expenses and its debts. If that's not the case, is the company using this financing to pay for asset investments that will bring it to some point in the future being able to cover its expenses with its operating cash flows? If not, why? All right. Any questions on cash flows or free cash flows? Sorry, cash flow statement or free cash flows? Yes. So in general, if you see negative operating cash flow, that's a big red flag. A company's operating cash flow, it's not it basically reflects the core operations of a firm and being able to cover itself. So if you see negative operating cash flows, that reflects that the company is incapable of funding itself through its own operations, right? So that'd be equivalent of an individual just taking off debt, like having a credit card payment of $10,000 a month, but they have income of $5,000 a month, right? Same idea with the company. If their operating cash flows don't cover themselves, they're not performing well. Now, there is the argument when a company is very young and just getting started in its operations, there's going to be cash outflows. Yes, that's true. But if they don't quickly revert that and start generating positive operating cash flow, the company's in significant liquidity conditions. Does that answer what you're looking for? Okay. Any other questions? All right, then, forgot the last one, investing and financing. So this ratio is basically just looking at a company's operating performance relative to the external conditions for its operations, right? So investing in additional assets, investing cash flow. What this ratio looks like over time kind of just is more conditional on the company's performance. Over time, we should see improvement with the operating cash flow relative to investing in financing. But like I said earlier on today, investing in financing is more conditional on the company's performance, so there's not a purely positive or negative way to look at this ratio. All just depends on what the evolution is over time and whether operating cash flow is improving. All right, so next time we're going to start talking about, actually I think this might be outdated. I'm pretty sure MD&A is what is on the docket for next time. All right, so we're going to focus on MD&A next time. I think that's going to be the more relevant bit. So talking about just what sort of information management we'll be talking about in companies' financial statements. And we'll be going through Walmart's MD&A a little bit more. Right, so this free cash flow metric that I brought up, that's a subset of their discussion and analysis, largely because free cash flow is how companies are valued. So we'll be talking a little bit more about some information contained in here. If there's not any other questions, then that'll be it for today.